Hi, all. Welcome back to Dividend Stockpile, where we talk about all things dividend and income investing related. Today, we're talking with Chandler Nichols, the VP of ETF Product Development at Advisors Asset Managers, or AAM for short. AAM provides a suite of investment products and solutions, including dividend-focused ETFs we're going to discuss today, which are BDIV, SPDV, and PFLD. Some of these names you might be familiar with, but I wanted to have AAM come on and speak in detail of each of these to raise the awareness of these ETFs. These ETFs offer a variety of dividend yields and strategies that you might find interesting to add to your portfolio or your watch list. So with that, welcome, Chandler.
Pleasure. Thanks for having me.
Awesome. Thank you so much for joining us. I really appreciate your time and ability to come and talk to us about these great ETFs you have. So let's just get right into it, I guess. So you're with AAM, and some people may not be familiar with that company, but can you give us a little bit of a background on who AAM is and what you guys offer?
Yeah, definitely. So yeah, I mean the firm we've actually been around for a little while. The firm was founded in 1975, actually as like a bond services desk. So think of that is like AAM as like this bond desk for hire for financial advisors, whether that be to help them create custom solutions in a bond portfolio, like a bond ladder or something, just to keep it like really high level in terms of what the original business was structured as. So the company itself is rooted in income, specifically fixed income. And fast forward, down the line, the firm ended up rebranding in 2008 to Advisors Asset Management as it started to get involved in the structured products world, unit investment trust world, as well as launching its first mutual fund a few years after the global financial crisis. So moving forward to today, I mean the ETF business was launched in 2017. I think everyone obviously is aware of the growth of the ETF world, and that obviously enabled the firm to want to join the space. And the first ETF we launched was an income oriented product, one of the ones that you were discussing in your introduction. And today, fast forwarding to 2025, we have 7 ETFs, both active and passive. We also, just to give a little more of a background in terms of how the firm is structured today, we really are like a distribution powerhouse. The firm is rooted in distribution. um, you know, Servicing many different clients with many different types of fund wrapper offerings across alternatives. We're also a wholly owned subsidiary of SLC Management, which is a large Canadian insurance company, and we essentially help third party asset managers with the number one issue in the product space, which is distribution, being able to get the word out about their strategies, their products, whether it be in any of the fund wrappers that I was discussing earlier. So, and this kind of also takes hold within our ETF stack as well, in terms of having access to, major sub advisors and boutique investment management firms within the space that might be lesser known to some, but well known within certain pockets of the investor community with really successful track records. So, really well known as a distribution powerhouse, with access to some really quality asset managers.
Okay, great. Yeah, it's nice that it has such a background, and a lot of these ETFs that are coming on board right now lately, the companies are brand new. They've only been around a year or two, but to know that AAM's been around for that many years and you guys have it established in the investment industry is very comforting for a lot of people who may not be totally comfortable with these brand new ETFs that are out there. So when did you guys, or when did the company start transitioning from an advisor focus to more of the retail client focus? Was that back when you guys did the ETFs, or were you dealing with individual clients before then?
Yeah, we've always been dealing with individual clients for some time. I'd say a lot of that happened around the time when we were getting involved within the structured product and UIT world, but specifically with the mutual fund world as well. So we launched our first mutual fund like shortly after the global financial crisis. Our main clientele is still definitely the financial advisor community. That's who we talk to the most. But naturally, being involved in the ETF space, we want to be able to reach out to all different types of clients and be able to provide what typically financial advisors are able to get access to, either in a mutual fund or an ETF, and bring that over to the ETF industry and put that in the ETF wrapper in order to just continue the democratization of access of different managers. Something that that's been a big trend in the space is naturally
Mhm.
the growth of actively managed ETFs. But it's not just the fact that some of these ETFs are active and they don't follow an index, but the fact that you're gaining access to a certain set of skills and portfolio managers that typically financial advisors and some large institutions have essentially only been able to obtain access to. And some of our strategies definitely speak to that. Like for example, some of the strategies that we have are already in existence in as a separately managed account within a different within that different within that different type of wrapper. So again, just being able to bring that sort of democratization into the ETF industry is how we really wanted to branch out and bring access to the retail community through through the ETF wrapper.
Yeah, that's great, and I love that about the ETFs, especially over the last couple of years. It really has become much more intricate and advanced than what ETFs used to be. You used to not have access to portfolio managers and things like that. If you had an ETF, it was basically just an index, and having all the different solutions out there right now and all the different strategies, and having access to the active managers within the ETF wrapper has been a huge benefit to individual investors like myself. So that sounds great. So can you explain a little bit more about your role at the company and what your background is?
Yeah, 100%. So, my background, so like I'll call it a little lukewarm. I graduated college in 2016, but my foray into the asset management industry began in 2018 at a significantly sized asset manager. But my ETF specific career really started working for a broker dealer, actually, as like a gatekeeper, as a ETF and closed end fund due diligence analyst, basically saying, hey, like here's some quantitative and qualitative metrics that we like to assess in order to say, to ourselves for the benefit of our financial advisors and to help them protect their
Mm.
clients. How do we want to assess the market in terms of from a quantitative and qualitative standpoint, in terms of onboarding new products, whether that be, brand new products and having guidelines for that, guidelines for existing products with certain types of criteria, like expense ratios, and looking at different types of liquidity metrics, just to give like a really high level overview and overseeing the ETF and closed end fund side of things in that previous role.
Yeah.
From there on out, though, I wanted to go back to the issuer side of things. So I did work for one of the larger thematic and option writing based ETF issuers for the past 3.5 years. But lo and behold, found myself at A.A.M. I joined in September at the end of 2024, and really kind of doing similar to what I was doing in my previous job, helping position products, so being like a product strategist,
Hmm.
but also in my current role in what I've been diving deeper into is the product development side of things, and definitely helping taking that level of pragmatism that we've typically had within the ETF business and offering both index based solutions and active based solutions, because obviously actively managed ETFs, as I mentioned, is a big area of the market, but we want to be able to assess and really provide the best whole solution, regardless of management style. It's definitely something that I'm really happy to be a part of now.
So can you talk about AAM's approach to income investing specifically? Obviously, this is a dividend and income investing related channel. So what's AAM's approach to income when it comes to your ETFs?
Yeah, again, I would say definitely a level of pragmatism. So, as I mentioned, our first ETF that we ever launched was SPDV, which you mentioned earlier, the high dividend value ETF. That was a passive based strategy. There was really nothing like it at the time in terms of combining the quality, value, and high dividend factors all into one strategy. That's pretty simplistic in terms of how it operates. Being able to take that sort of mindset and look for, basically saying to ourselves in the product development phase, like, hey, who do we have? Is there a certain manager that we have access to that has a good strategy that we can bring into the ETF wrapper for an income based for an income based mandate? And if not, can we do this in in the indexing space? For example, like in the preferred stock space is another is PFLD, which we also have a passively managed index tracking strategy for. So, but On the active side, like I mentioned, our income suite is, out of our 7 products, we have four of them are income oriented, and of those four, 2 are the passive ones that I mentioned earlier, and 2 are active. So, BDIV, that dividend growth strategy, and we also actually launched a fixed income short duration product, which really is definitely like what I view as like taking pretty much the definition of taking an institutional grade strategy and putting it in the ETF wrapper. It's managed by one of our affiliates at SLC, who manages hundreds of billions of dollars of fixed income oriented assets and securitized and corporate credit. So again, being able to see if there's different areas of the market, and taking that pragmatism and putting it into something that we believe can garner some traction and continue to open access for the end investor.
Definitely. For the fixed income one, what was the ticker on that one so everyone can look it up?
That one was a LODI, LODI. It's the AAM SLC low duration income ETF.
Okay, awesome. I'll pop it up on the screen as well for everyone. All right, so let's get into some of those ETFs you mentioned. So the first one I want to talk about is BDIV, the A.A.M Brent View Dividend Growth ETF.
Yep.
Give us a little bit of background on the strategy on that one.
Yeah, 100%. And it's so some background in terms of like when we even launched it and stuff like that. I'll get into like the high level stuff. It's a dividend growth strategy. We launched it on July 31st of 2024. So fairly new in the ETF wrapper, but the strategy itself has been in the SMA format for well over a decade, close to 2 decades now. The portfolio managers have decades of experience in dividend growth investing, and dividend growth investing is really interesting because we really do think that we're doing something pretty intriguing in terms of the active management component of this strategy. Brent View Investment Management likes to take a differentiated approach in terms of being unconstrained. So what do I mean by that? To take a step back, I think giving a lay of the overall dividend growth landscape is also pretty helpful too, because it's a large landscape. It's been around close to since the inception of the ETF. Some of the earlier dividend growth ETFs have been around since the early 2000s. So not too far off from that from when SPY launched in '93.
Mm-hmm.
But essentially, what a lot of these indexes do is they basically say, here's a universe of stocks. Find me the ones that have been growing their dividends for X amount of years, over that specific pre-specified time frame. And the amount of years that they'll choose will be 5 years, 10 years, 15 years, 25 years, or even 50 years. We've seen
Mm-hmm.
from our standpoint, we view that as something that is a little subjective in terms of stock picking in a portfolio. So we worked with the experts at Brentview Investment Management. We have a long-standing relationship with to bring their SMA based strategy into the ETF wrapper and provide access to a strategy that's unconstrained, because it also this is like the kicker in terms of why we believe we're differentiated, is that it can also include dividend initiators. So companies that are starting to pay a dividend for the first time. These companies tend to, demonstrate a level of earnings growth that may be more attractive than a company that has been maybe slowly growing their dividend for a 25-year time period just to stay in those aforementioned indexes. So the dividend initiator component we think is really interesting, and also fast growers. So maybe it's a company, for example, that is been consistently growing their dividends for maybe just a few years. So
Mm-hmm.
maybe the indexes aren't picking them up yet, but from the portfolio manager standpoint, they're able to naturally add a company like that earlier on, should it meet their fundamental criteria that they look for. So speaking of fundamental criteria, I think that kind of goes well into just to how like the portfolio is sized and what they're looking for. Naturally, consistent earnings growth,
Mm-hmm.
consistent cash flow growth, commitment to paying a dividend naturally is going to be the key point of the stock picking that the portfolio managers are looking for. And the deterioration of any of those will potentially trigger them to maybe sell a stock, should they feel that is the right decision to do. But in terms of sizing, the portfolio will typically be anywhere from 30 to 40 names,
Okay.
mainly US equities. They can include international equities up to a 10% cap, but mainly US equity portfolio still. They'll typically cap their sector exposure up to 25%. And each individual company at purchase will be anywhere from 2 to 4% of the portfolio.
Okay.
That's the overall sizing in terms of their time horizon that they're looking for based on those like fundamental and profitability metrics that I was mentioning earlier, typically anywhere from 3 to 5 years. So this is definitely like a buy and hold strategy and a high conviction portfolio of concentrated names. So yeah, I mean the overall portfolio, definitely we think overall from a portfolio usage standpoint, what we've seen, at least in the financial advisor community, it's a dividend growth strategy. The goal of the portfolio is naturally to still get a higher level dividend yield in the S&P, get
Hmm.
a higher level of dividend growth in the S&P, but also with a lower beta. So we do look at this as like a true core U.S. equity holding,
Hmm.
a quality factor type of strategy, utilizing dividend growth as that main metric there. And in terms of but also can also fit naturally within an equity income sleeve as well, given the goal of the strategy being to still potentially achieve a level of higher income relative to the S&P 500 as well. So we really do look at it as something that could be like a nice piece of a core U.S. equity portfolio sleeve. But yeah, I mean, we think now is definitely like, I mean, from a dividend growth standpoint, I'll kind of just leave this there with the overall strategy, and maybe like a why now for dividend growth investing. I mean, in terms of what we're seeing in the regarding the volatility in the market at the time of this discussion has been pretty significant with the sell off in the Magnificent Seven. I mean, BDIV has a little bit of exposure to the Magnificent Seven, but it's a lot lower than that of like the S&P 500 or the Nasdaq. So we do look at it as a little bit of a nice diversification play within a core U.S. equity sleeve as well for those looking just to expand their sector biases a little different. So like right now, like BDIV's a little bit overweight in the consumer staples sector, which has been performing pretty well. As of this discussion, just to kind of give a little bit of how the portfolio is currently positioned, a little bit of background there.
Okay. Yeah, that's great. So just a couple of the metrics. The yield as of today is 1.40, a little bit higher than the S&P 500. The expense ratio says a 0.49, but it isn't actively managed. And some of the top holdings include Microsoft, Apple, Train, T-Mobile, and United Healthcare. So those are top quality names. Everyone in the dividend space knows those names and more than likely is investing in them. But to your point, you do have the flexibility to pick other names that fit the criteria, which is really good. You're not going to have the same, and you don't have the same restrictions as something like DGRO or SCHD, where they have to have a certain amount of years of dividend growth and things like that in place before you go into the fund. So that's a really nice strategy. And to your point, hopefully the dividend growth will be higher than the S&P 500 and some other ones that you. So those are for people who want access to S&P 500 type of names, but want a slightly higher yield and a higher growth than the S&P 500 might offer you. Okay. So let's move over to your high dividend value ETF. So that's the AAM S&P 500 High Dividend Value ETF SPDV. So how is that different than the one we just spoke about?
Yeah, so it goes back to I think two different schools of thought in terms of dividend investing, which I'm sure a lot of viewers are definitely familiar with. You have high dividends and then dividend growth. Dividend growth, you're looking for companies that are growing their dividends at a fast pace or over, like I mentioned, a specific time frame, regardless of their actual dividend yield.
Mhm.
Whereas you kind of flipping that over its head now in terms of a high dividend yield strategy, you're looking for companies that are really high yielders in terms of, relative to their peer group or relative to their initial universe in terms of what SPDV is doing. So that's like the main difference between those strategies. So SPDV we would anticipate to have like a higher dividend yield relative to BDIV over the long term. BDIV's more of like that growthier type of play, whereas SPDV is like that consistent high dividend payer in terms of its overall strategy. So, just to give a little bit of a background on the strategy, as I mentioned, it was our first launch at AAM. SPDV was launched in 2017, so it's been around for close to 8 years now.
Yeah.
And we're starting off with the S&P 500, so we're starting off with a really good initial universe because the S&P 500 is obviously the most well-known stock index in the country, has its own set of criteria of its own, requiring profitability and being able to be of size. So basically, the market has also kind of given credence to the stocks that are within that index as well. Starting off with that initial universe, we're essentially enacting a high dividend yield screen and a free cash flow yield screen, and basically calculating a composite score. Once that composite score is calculated, it's choosing the top five, the highest scores, the top five highest scores in each GIC sector in order to construct the final portfolio. So you have 11 GIC sectors,
Mhm.
five companies per GIC sector, 55 companies total, equally weighted portfolios. So we're really trying to spread out. Like we're really like, diversification is definitely the key in terms of the final selection and in terms of the overall weighting scheme. So typically, not like upon a rebalance, not one sector is going to make up 10% of the portfolio. So you're really overweighting some of those more defensive sectors that typically are underweight in the parent index, being the S&P. So when we were seeing that, right now in terms of some of the, again, coming back to like that Mag 7 sell off that we're seeing this year, SPDV has definitely been holding up pretty well, a little differently relative to the market because even though it's filtering from the S&P 500, its overlap to the S&P 500 has typically been anywhere from 5 to 10%. So pretty high active share, pretty
Mhm.
low overlap to its own parent index. And that has allowed the strategy to, one, be a nice equity income play in a portfolio, obviously, but also a nice deep value play as well for investors looking for something that's a little bit differentiated from a typical, growth style type of strategy. You can use SPDV as a counterbalance in order to kind of get the best of both worlds and overweight some of those more defensive sectors. So yeah, and in the current environment, from our standpoint, you know, interest rates are obviously pretty high. They've been lowered
Mhm.
by 100 basis points since the end of 2024. And it's our view that we think, higher for longer is here to stay. Naturally, some of the macro news that we've been seeing in terms of like trade wars and the potential impact on inflation expectations could potentially result in a higher for longer interest rate environment. But should rate cuts end up ensuing and come at a maybe a quicker rate than some might be expecting, definitely a play like SPDV could potentially be a nice fit for those looking to take on equity risk in order to increase the income potential of their equity sleeve as well. So definitely seeing a few ways in terms of how advisors are looking to use SPDV from like that counterbalance to a
Mhm.
typical growth play, but also obviously as an equity, traditional equity income play within their core U.S. equity sleeves as well.
Yeah, what I really like about this one in particular, SPDV, is the sector allocation. I think that's a really unique way of approaching it. Take the 11 sectors and pick five of the quality high dividend yield names on each one to give you true diversification. So to your point, you're not stuck with the uh, the biggest names taking up the majority of the portfolio. It balances out pretty well. And just for everyone's awareness, right now the top holdings are Gilead, AT&T, IBM, Verizon, and Johnson and Johnson. So obviously that can change over time, but those are very defensive, stable names that hopefully will hold up well in all market conditions. Showing the expense ratio at 0.29 and the current yield is around 3.8. So definitely a lot higher than the previous one we talked about to give you that current income right now.
Yep. Yeah, and then look, and also in terms of like the overall portfolio, no Magnificent Seven exposure. Those definitely aren't high dividend yielders, at least at
Yeah.
this point in time. So yeah, definitely like we've again kind of goes back to like just the overall diversification, strategy that's taken place within the index that it's tracking.
Yeah, and you're still going to get those five names in the information technology sector
Yep.
and the communication services sector, where we're just looking for the higher yielding ones in those sectors. So you still get exposure to each one, but you don't have the Mag 7, as you said. Okay,
Yep.
awesome, good. All right, let's switch over to the last one I want to talk about today. This is your preferred and income securities ETF, PFLD. And I know a lot of people in the community either already own this ETF or definitely heard about it, but preferred stocks are usually one of the last things people start investing in. So can you kind of tell us about this fund, maybe obviously what they do, but also who is maybe geared towards?
Yeah, yeah, 100%. Honestly, I'll start with who it's geared towards first because I
Okay.
think it's definitely the main reason for why we've seen demand, and that's the potential for tax efficient income. So, and I think this honestly gets into a little bit of a deeper discussion in terms of what is a preferred stock to begin with. Preferred stocks are hybrid securities.
Mm-hmm.
They sit in the middle of the capital stack, lower than bonds, higher than common stock. So, because of that, they also tend to share some similar characteristics to each of those as well. Like a bond, they're sensitive to interest rates. They don't have voting rights. But like a common stock, and this is kind of where I'm going with this, is that they pay a dividend. They don't pay a coupon. A preferred stock pays a dividend, and that dividend, depending if it meets certain holding period requirements and the other requirements as well, can potentially be receive a characterization as a qualified dividend. So
Hmm.
that's being able to achieve a higher level of tax efficient yield within a fixed income portfolio is something that clients are highly sensitive to, given the fact that bonds are typically taxed at the highest ordinary income rate for an investor. So that's typically the reason why investors look to preferred stocks overall. PFLD has typically seen a large majority of its dividends historically get that QDI tax characterization as a commonality within the preferred stock ETF space. That's really the like a good reason as to why we've seen a lot of demand for this strategy in particular. It's also one of the higher yielders within the space as well. But just to kind of go into how we kind of thought about this strategy is that from an index based standpoint, there was no one else enacting the screens that I'm about to go through in terms of the portfolio from an index based standpoint. So we're starting off with a broad universe of the U.S. exchange listed preferred stock landscape. So U.S. dollar denominated preferreds, and we're enacting two screens. One, I kind of alluded to it, and it's in the name too. It's the duration screen. Any preferred stock with a duration over 5 years, an option adjusted duration over 5 years, is going to be removed. On
Hmm.
top of that, any preferred stock that is trading above 5% of its face value is also removed from the portfolio as well. So the reason for that is even though it's a low duration strategy, it is still evergreen from the standpoint of in a rising rate environment or high or period of high interest rate volatility, the strategy, that duration screen is going to be able to help mitigate a level of the interest rate risk that is significantly present within the preferred stock market. Whereas that call screen's also really interesting because it can potentially be something of use within a declining interest rate environment. So, what do I mean by that? So, preferred stocks are typically, and like a bond, can have options embedded in their securities. Preferred stocks are largely have a call option embedded within them.
Hmm.
Typically, within 5 to 10 years, gives the issuer the right to call it back at par value.
Yep.
Naturally, if rates are declining and they can, buy back that preferred and then issue a new one at a lower interest rate, they will definitely do that in order to, help them manage their balance sheets. By having that screen, that call risk screen, we're able to limit a level of that and the reinvestment risk that comes with that as well. So, being able to have those two screens kind of counterbalance one another for both types of interest rate environments, we thought was really key when launching the strategy. And yeah, the overall, just to give a little bit, and this is similar within some other preferred stock strategies as well. But PFLD typically lean, and this is the preferred stock landscape in general, typically leans towards big banks,
Hmm.
utilities companies. These are highly regulated industries
Yep.
that typically have to meet certain capital requirements or capital ratios as per the regulations that they have to abide to. So those are typically the sectors that PFLD is exposed to. There's some real estate exposure as well. Some mortgage REITs can
Hmm.
be found within the portfolio, and the overall credit quality of the portfolio will definitely differ upon a rebalance, but a majority of it is within that triple B range. So definitely a strategy that we've seen investors utilize in maybe it can be in an alternative sleeve because again, preferreds are pretty
Hmm.
different, from fixed income and equity in terms of they're similar, but when you combine all their differentiations together, they are a little different than each of those types of securities. So we've seen investors use them in that scope, but also, and this is probably the primary way we've seen them used, but also as a complement within like a high yield credit sleeve in a portfolio as well, in order to increase tax efficient income. So yeah, PFLD and is definitely something that we're really intrigued by right now, just because high interest rate volatility, given some of the concerns about again tariffs and the
Hmm.
potential for elevated inflation and elevated interest rates, and the strategy overall has grown. It's our flagship fund. It's grown to well over 500 million in assets as of this discussion, and it's a lot of it has to do with the fact that it's offering a high distribution rate while also being able to to, again, get some of that tax efficiency as well.
Yeah, that's great. Just for everyone's awareness, the yield is around 6.69 right now, and expense ratio is 0.46%. And some of the top holdings, like you said, are mostly banks. We have Goldman Sachs, JP Morgan Chase, Duke Energy, US Bank Corp, and Athene Holdings are the top holdings as of right now. Obviously, subject to change, but it just gives you a sense on the quality of the names that these preferred stocks are from. That's the tax efficiency is definitely a big benefit because a lot of these other ETFs out there, like the cover call side of the business, a lot of those are taxed at ordinary income rates. But to have a high yield in the high sixes and get a tax efficiency with a long-term capital gains tax rate is a huge benefit for those people. And it's not how much you make, it's how much you keep. And if you have to pay less taxes, you're going to keep more. I also like that it's a monthly distribution. So that was really helpful for those who are relying on the income right now.
Yeah, 100%. I couldn't have said it better myself. I mean, it's definitely, yeah. I mean, the tax efficiency is something that we get asked about the most in terms of the overall strategy. And then also, I mean, PFLD, even and this is really what we find also really interesting about it is that, look, it's an index-based strategy, but it also rebalances monthly as well. So even though it's passive, it's highly active. Like the turnover can definitely be significant at some times, less significant during some other times, just depending on how the overall makeup of the initial universe is. So we do look at this as something that's like, look, it's passive, obviously by all accounts, but it is fairly active in terms of the portfolio management that's going on based on the index criteria that has been set before it. And then honestly, one last thing that I would add, because I think this is actually really important just
Mhm.
for the viewers to be aware of. I think 2023 we saw like that regional banking crisis occur,
Mhm.
and kind of saw the word contingent convertible within the space as well kind of come up, and some of the concerns regarding that specific type of hybrid security structure come into the limelight because PFLD concentrates on US dollar denominated preferreds and US domiciled preferreds. The strategy wouldn't be expected to own those types of securities, so mitigate some of that risk that investors were definitely showed concern of from that specific structure that is typically found within the European side of the preferred and hybrid securities markets as well.
Okay, thanks for the additional information. Yeah, I mean, I think just generally, if someone's investing in preferred stocks, they're probably a lower risk type of client. So anything that we can do to mitigate those risks out there is probably a good thing for this client base.
Definitely.
Cool. All right. So thank you so much for reviewing those three income-related ETFs. I think you guys offer a great variety of suite of products, something for the dividend growers, the current dividend, and the high-yield dividend. What other products would you like to mention today before we wrap up?
Yeah, I mean, I think I kind of alluded to it earlier. LODI, LODI. It's our, just to kind of bring in the whole income suite together. It's our newest launch. We launched it actually at year end on December 4th of 2024. Really interesting strategy because, as I mentioned, it's sub-advised by one of our affiliates, SLC Fixed Income, experts in the space. It's a true bottoms-up, fundamental-based fixed income strategy, where it's essentially being its duration neutral when I'm to its benchmark, meaning that its duration will typically they'll try to kind of like match the portfolio duration of the benchmark, which is the Bloomberg 1 to 3 year government credit index. So low duration, 1 to 2 years. So most of the value add, and not all the value add on the active management front, comes from that bond selection process, in which they are also pretty unconstrained in terms of the sectors that they can invest in, and
Mhm.
that's totally based on the way how the portfolio managers interact with one another in terms of where they feel like the relative value is currently in existence. So on the securitized assets front is where like the portfolio is currently well positioned, because that's an area that right now at this present time offers some nice relative value and relative yield potential versus corporate credit, and that can shift over time. So we like the nimbility of the strategy and the fact that it's pretty unique and time tested in an institutional format. So yeah, I mean, when I mean securitized assets, I mean like asset-backed securities,
Mhm.
collateralized loan obligations, so CLOs, commercial mortgage-backed securities, MBS pass-throughs, et cetera. Being able to again potentially enhance a portfolio's income. In a time of rising rate environments, like we're seeing right now, and in terms of being in an elevated interest rate environment, where being able to lower the duration of a portfolio is how we kind of look at this strategy. It's a core solution, but on the short end of the curve. But again, if rates end up declining from here on out, and investors are looking to deploy, different, whether that be like a cash or cash alternative, like a
Mhm.
strategy, and kind of find their way out of that, while being able to look, I mean, this strategy credit quality typically investment grade from triple B to single A. So you'd be increasing credit quality, you'd
Mhm.
be increasing credit risk, increasing a little bit of duration risk as well. So if the investor is willing to do that, a strategy like LODI can be used as a way to increase the income potential within, as like a cash or cash alternative type of sleeve as well.
Yeah, and so I see
Yeah.
the expense ratio is pretty small on this one, 0.15. Do you know what the yield is right now?
Yeah, it's a little under 5%. I think
Okay.
well, last time I checked, it was like 4.94 in
Yeah.
terms of the SEC yield.
Yeah, that's great. And, having a short duration, um, cash like, I won't say cash, but like,
Yep.
relatively safe, get that type of yield is definitely something that's probably interesting to a lot of people, especially with all the volatility we have right now. Maybe people aren't quite ready to put their money to work in equities. They can put it here in something like LODI, get a good amount of interest while they're waiting to decide what they want to do.
Yeah, exactly. And a monthly payer as well, like all of our income solutions. So like yeah, all of the income solutions we've discussed are monthly payers, and that's LODI as well. And yeah, the 15 basis point expense ratio is pretty competitive in terms of the overall landscape. So we're really happy about that.
Yeah, especially for an actively managed fund.
Yep,
That's a great rate. Okay.
definitely.
Well, thank you so much for discussing that one as well. Really appreciate your time coming on.
Yeah.
Where can people get more information about AAM and the products you guys offer?
Yeah, so aamlive.com, you can learn more about the entire firm through that specific web link. But if you do aamlive.com/ETF, it'll take you straight to the list of all of our ETF solutions. And within each of those pages, I mean, we update our sector breakdowns on a daily basis. We have different insights pieces and spotlight pieces that kind of give a broad overview of these strategies as well as presentations. So if anyone looking to learn more, that's definitely the place to go to.
Awesome. And like any other ETF, they can buy it on their favorite brokerage company. There's nothing special there, right?
Major discount brokers, they're about like your Schwabs, Fidelities
Yeah.
of the world, Interactive Brokers, definitely.
Awesome. Okay.
Yep.
Well, perfect. Chandler, thank you so much for coming on and discussing these great products. It was very nice talking to you. Hopefully, we'll get a good response from the community. Everyone out there, if you have questions for Chandler, go ahead and send them in via the comments on the video. We'll get them over to Chandler, and he can help answer any questions you have. If not, reach directly out to the firm at aamlive.com.
Thanks
Awesome.
for having me.
All right. Thanks, Chandler. Appreciate it.
Have a good one.
You too.